Welcome to another episode of Stock Talk. If you guys are new to my channel, my name is Julie. Please be sure to hit that like button on your way out, only if you guys get anything out of this video. And if you're not already subscribed to my channel, please be sure to do that as well. I would greatly appreciate that. Now, in today's video, I want to talk to you guys about two Dividend Kings stocks that I think could greatly benefit from the rising oil and gas prices. But before we talk about these two stocks, let's take a look and see what the definition of a Dividend King stock is. So in order for a stock to qualify as a Dividend King, it has to be publicly traded. And in addition, it has to show that it has grown their dividend payout for at least 50 consecutive years. So these companies have a proven track record of rewarding their shareholders with a regular dividend payout. So the first Dividend King that I want to talk to you guys about is National Fuel Gas. And National Fuel Gas is a diversified, vertically integrated natural gas company. Its upstream segment generates 46% of its EBITDA, while its midstream segment and its utility segment generate 38% and 60% of its EBITDA. Now in 2020, we've seen a fierce downturn in the demand for oil due to the coronavirus. However, we saw that the demand for natural gas pretty much remained firm. And as a result, we can see that National Fuel Gas has proved itself to be resilient throughout the pandemic. Taking a look at the last earnings report, we can see that earnings per share rose 40% from $1.06 to $1.48, and it exceeded the analyst consensus by 15 cents. Now, this company actually has exceeded the analyst estimates for 11 consecutive quarters. And thanks to the improved outlook for natural gas prices and oil prices, the management has actually now raised their guidance for the annual earnings per share twice this year, from $5.05 to $5.20, which is roughly 24% growth. Now, the analysts are expecting for the company to earn at least $5.60 per share this year. And if this actually pans out, then that will mark 31% growth over last year, which would be a new all-time high. Additionally, if we take a look at the company's evaluation, we can see that the trailing 12 months non-GAAP is currently trading at roughly around 13, whereas the sector medium is trading at 19.62. And we can see that they received an A grade. And the forward non-GAAP also received an A grade since it's trading roughly around 11.41 versus the sector medium of 19.27. Looking at the growth, we can see that the company had a year-over-year growth of roughly 20%, and the medium sector only has a year-over-year growth of 10%, so that's doubled. And with the forward revenue growth is estimated at 15%, that actually represents 3 times the growth of their competition. And the profitability of the company is also rated with an A-, showing at 61%, whereas the sector medium is only 41%, and the EBIT margin is at 37%, and we can see that the sector medium is only at 20%. So all these numbers look pretty nice if you guys are an income-seeking investor. Now, taking a look at their dividend itself, the company has actually paid an uninterrupted dividend of 119 consecutive years and has grown its dividend for the last 51 years. The current payout ratio is right under 40%, which is fantastic. Now, they do have a fairly conservative yield of 3%, but I like this because this company also gives very conservative guidance, which as an income-oriented investor, these numbers should look very attractive to you because you want to be sure that you are investing in companies that are more conservative and therefore can actually beat their analyst forecast, because we've seen time and time over again that the stock market actually rewards companies that beat analyst estimates. And even though the dividend yield is conservative, it actually is double than the yield of the S&P 500. So let me know in the comments below what you guys think about this stock and if you would consider purchasing it. Now, moving on to the second stock today is Emerson Electric. Emerson Electric was founded in 1890, and since then it has continuously grown via strategic acquisitions and organically from a regional manufacturer of electric motors and fans into a diversified global leader in technology and engineering, and currently has a market capitalization of $56 billion. Emerson generates a great portion of its revenue from the oil and gas industry. In the first quarter of fiscal 2022, Emerson grew its revenue by 8% over the prior year's quarter. The estimate was 99 cents per share, but that came in at $1.05 per share. So that's a change of 26% year over year. And if we take a look at the history, we can see that this company has not missed the analyst estimates by 13 consecutive quarters, which is due to their strong business momentum and its bright outlook. And even better, thanks to its strong business momentum and its bright outlook, the company has raised its guidance for the annual earnings per share from $4.71 to $4.90, which implies a 21% growth over the prior year. Now, MSN's dividend yield is also on the conservative side of only 2.24. However, I think in the coming years, we could see they're steadily increasing their dividends as they have done for the last 65 years. So yes, they've been raising their dividend for 65 consecutive years, which is one of the longest growing stock streaks in the investing universe and a great achievement, especially given the cyclical nature of the industry sector. And the payout ratio we can see is only 47%, so I think that's a really great balance there. Again, let me know if you guys considering purchasing MSN stock, why or why not. And if you guys have any questions or comments, please be sure to leave them below and I'll be sure to answer all your questions. Again, thank you for watching this video. I hope you guys got something out of this and I'll see you guys in my next video.